The Commerce Department today revised its estimate slightly higher for fourth quarter U.S. gross domestic product to 2.4%. However, economic concerns mounting as worries rise of a tariff and trade war. Our next guest sees the U.S. capable of averting a recession this year. RBC Capital Markets US economist Michael Reid joining us to discuss. Thanks for being here, Michael. So,
thanks for having me.
What does this scenario look like where we avoid a recession, and how? I mean, there are a lot of balls in the air, so to speak, right now. So, how do you figure it out?
Yeah, so we've been flagging a lot of these things that have signaled uncertainty in the economy. And while those are things like the University of Michigan Consumer Sentiment, Conference Board Consumer Sentiment, those are what we call soft data. What we aren't seeing yet is weakness in the hard data. So for us at RBC, we recently revised our growth forecast for the US down to about 1.5% for the year. That was down from 2%, which is consistent with that historical growth trend. But I think the risks are certainly starting to rise when you think about all of the uncertainty that's been created by things like the DOGE cuts. Now we have tariffs coming into play, inflation that remains sticky, and just general sentiment for the consumer. That means maybe they start to pull back.
What about, Michael, I asked you about the news of the day, which is tariffs. Trump plans impose a 25% tariff on imported vehicles. Just how, as an economist, you see those headlines and you try to make sense of them, what it means for inflation, for growth. What do you tell clients?
Yeah, it's tough, and I'm thinking about it in terms of what this might mean for the Fed. Mm-hmm. And Chairman Powell was talking about this in his last press conference. He used that T word, transitory. Mm-hmm. Are the tariffs going to be transitory this time? And I think there's a risk given this start and stop kind of scenario we've seen with respect to tariff announcements. Now you have to worry about retaliatory tariffs. If we get into a trade war, these won't necessarily be transitory. You could see multiple months where those tariffs, new tariffs are announced, and those start to push up inflation, and we really start to
So it moves,
lose.
Michael, from something transitory to something more persistent?
Yeah, absolutely. And already, you're looking at base effects this year. It's something we've highlighted wherein you're just not going to see a good path for inflation. We think core inflation, absent these tariffs, ends the year north of 2.5%. So now that you're introducing higher costs on something like autos, which is one of the biggest components of inflation, that adds a risk that maybe we end closer to 3% for the year.
And you had Fed President Alberto Musalem this week talking about this as well, this possibility that not only would you see the primary effects of the tariffs, that is the actual cost on the thing that it's affecting go up, but secondary effects where you start to see other inflation sort of surrounding it also rise. How does that sort of work, and is that one of the reasons that it could be more persistent?
Yeah, so when you think about how these tariffs are being described right now, it's about the content. So there may be an increase in demand for domestic parts or other domestic components, and that would increase the price ultimately for those. And that's at the cost of kind of moving away from imported products. So it's more so a push to get into compliance with how the tariffs are designed.
Well, we talk about these tariffs, Michael, and it's important just to always mention what seems to be Trump's policy goal here, which is to encourage more domestic manufacturing. That is the long-term policy goal and objective. As an economist, I'm just curious what you make of that objective and priority.
It's tough in this environment, and by that I mean we really start to wonder, where's the labor supply going to come from? We've talked a lot about just demographic forces here in the US. We're in this peak baby boomer retirement age. The workforce is really being lowered by retirements. You have workers leaving. You now have immigration that is slowing. So the availability of workers to find folks who want to work in manufacturing is going to be quite difficult. The manufacturing sector itself is one of the older sectors in the US, and they're located in places where there's generally population decline, notably around the Midwest and the Great Lakes. So you have to think about how are you going to get people to move to places where that manufacturing is occurring. And that's a tough spot right now with respect to the housing market and what's going on there, where you have this, effectively a mortgage lock-in rate that's preventing people from moving.
And something else I wanted to ask about is, especially with the tariffs on places like Canada and Mexico, and regarding China as well, there's been some talk, it won't drive the U.S. into recession, but it could drive Mexico and Canada into recessions. But wouldn't that then be bad for the US, since even with the tariffs, they're still huge trading partners?
Absolutely, they are. And while they're certainly more reliant on the US for their activity, we're not expecting to see strong growth in the US, certainly in these types of scenarios. We had modeled initially when we estimated 25% tariffs on Mexico and Canada respectively, that the US would be closer to no growth. So again, not necessarily a recession, but you're talking about a very squishy environment where it's certainly not going to feel good for businesses nor consumers.
I want your thoughts as well, Michael, on the labor market, which seems broadly stable, sort of cooling, not crashing. That's been the mantra. We do have Elon Musk and the Doge boys. They want to cut. I'm just curious how you see the labor market right now. What do you see over 2025?
So we do see a labor market that remains tight. And again, part of that story is this retirement effect, wherein we saw 1.6 million retirements last year. We think we see a similar number this year. That could come into question. You could see delayed retirements if there's a further pullback in the stock market, for example. Some folks may delay that decision to retire. More importantly, though, when you think about, again, the slowing of immigration, that's reducing the inflows that previously were pushing up that unemployment rate last year. So now, in thinking about this kind of low hiring, low firing environment, while there have been announcements from Doge, it's just not showing up in the data yet. We're not seeing it in the claims data. Yes, there have been some cuts, but even OPM came out and kind of revised one of their memos on March 4th that put into question the viability of these probationary layoffs. So, even at a high-end estimate that we put out, thinking about what a full-on Doge layoff would do to the labor market, it would really only, in our estimate, push up the unemployment rate by about 0.3. So you're talking maybe 4.4% by year end.
We've been talking all about tariffs, but there's other sort of policy stuff that I imagine as an economist you're paying attention to: taxes and whether the tax cuts get extended. And then, of course, there's the debt ceiling that's going to come into play once again. The SIBO says that the U.S. is going to run out of ways to pay its commitments by August, September at the latest. So how closely you're watching that? How important is that to the growth picture, too?
For us, I think the growth picture really relies on the tax cuts and what that means for consumers. The consumers, by and large, are the biggest driver of growth here in the U.S. So if you do see tax rates move higher for consumers, especially high-income consumers, that would be a risk to our view for growth, especially as it relates to the top 10, 20% of income earners who have really been driving a lot of the growth here in the U.S.
Yeah, makes sense. Thanks, Michael. Appreciate it.
Thanks for having me.